Mortgages in Australia are getting harder to pay, and that's because the Reserve Bank is raising interest rates every month and pushing our cash rate up into restrictive territory. ANZ thinks that we will see a peak of a 4.1% cash rate this year, which will not come down at all until late 2024. So how is this affecting mortgages? We know that already 70% of mortgage debt is variable. So that means for every $100 of mortgage debt in Australia, $70 are variable and $30 are fixed. Now this is still a little bit above the pre-COVID level where 20% was fixed and 80% was variable. But we are getting closer to coming back to normal. And by late this year, we should see a much more normal mix between fixed and variable loans. That is because of a fixed rate roll-off. We're seeing a lot of people who got those super cheap fixed rate loans in 2020, which were a result of RBA monetary easing, and they're going to be coming off onto much higher interest rates. What this means is that when people on fixed rates come into much higher interest rates, they're going to be suddenly paying a lot more on their loan. So will this cause a recession? What is this going to do for the economy? When people are on fixed rates and come off to a much more expensive variable payment, they're likely to have to slow down their spending. We actually think that overall, in the second half of the year, per person, there won't really be any spending growth at all. This is something that happened in 2018 and a few other times over the last 20 years. Because Australia's population grows quite quickly though, we're not going to see that cause a recession. One of the upsides for people in the mortgage market is that even though there is a higher risk of financial stress or a higher risk that you'll be squeezed by paying more on your mortgage, there's actually a much lower risk that you'll be squeezed on your mortgage due to a job loss or an income disruption. The Australian unemployment rate is still far below the any time between 1975 and 2021. We're still seeing extremely high job vacancies and we're still seeing employers screaming out for workers. So the risks to the fixed rate roll-off is that a lot of households will likely slow down their spending, but because the risk of unemployment is so low, this will somewhat offset the impact on the arrears rate.